Off with a session looking at gold, and to start us off we're going to have Cameron Alexander of GFMS Refinitiv, and he's going to start us off with a couple of slides, and then we're going to get to ask Daniel Hynes to join us on the stage to have a little chat about gold. But Cameron, over to you.
Thanks,
for
Leo.
Starters.
Coming. There we are. Thank you very much for people who have stayed around for the last session of the day. Look, I'm Cameron Alexander. I head up our precious metals research for the GFMS team at Refinitiv. You may not have heard of Refinitiv, but this was born out of last year. We're 1 year old now. Last year, Thomson Reuters sold 55% of their business to Blackstone in the US. It's the financial and risk part of their business, which was renamed Refinitiv last year. And GFMS was part of that move across to this new business. Right, so you might be aware of the GFMS name. That's been around for a long time. The Gold Survey 2019 was the 52nd book, basically, in a series that started way back in 1967, and sort of really reports on the fundamentals of the market, but we also delve into the macro side as well. Now, fundamentals really do not drive the price by themselves, obviously, but it's worth understanding, what are the dynamics in the market in any 1 year, and what is expected in terms of supply and demand as we look forward in the next few years. So, really, I wanted to firstly just start with the annual global supply-demand balance from last year, just to give a brief summary of developments. Because this year has been quite significant change, so I really wanted to start for last year, and then we can move on to what's happening in 2019. So we saw a modest rise in supply last year, up some 2%, and that was basically due to stronger mine production, which was up around, as I said, 2%, thanks to gains in Indonesia and the United States, while scrap supply declined slightly last year, mainly driven by weakness across Asian markets. So total physical gold demand increased by 4% last year, after a double-digit rise the previous year. As you can see there, jewellery was weaker by some 4% last year, with gains in North America offset by falls in Europe and the Middle East, and offtake in Asia, which was down by some 5% last year. That was dragged down by a double-digit fall in India. Meanwhile, we saw gold demand for retail investment that rose by 6% last year, and that was driven higher by a rise in both investment bar and coin, while demand from the official sector, so central bank buying, surged in the final quarter of the year to reach net purchases of over 540 tonnes. That's almost a 50% rise on the year prior. And this was the highest level since 2012. So as a result, the gold market remained in a physical surplus for the third consecutive year, although at a lower level when compared to 2017. So I just want to look at a couple of individual sectors just to highlight. And so total identifiable investment, which includes the physical bar investment, coin and ETP inventory build, posted a 4% annual decline last year. This was the lowest global identifiable investment figure since 2015. So demand for physical bars rose 4%, and demand from North American region continued to see a substantial decline, mainly due to the strong performance of the US equity markets. Increased bar demand from Asia, Europe and the Middle East regions was sufficient to offset the decline that we saw in North America. Official gold coin fabrication increased by 17%, so quite an impressive result. That was the highest level since 2016, with Asia contributing the bulk of this growth, with an increase of almost 70% on the year. Meanwhile, total net flows into gold ETPs hit 2.7 billion last year. That's down from some 7.3 billion in the year prior. So analysis of the CFTC data reports on gold managed money positions suggest that investment demand last year was rather weak, particularly in the second half of the year. Investor positions switched into net short in July and recorded 21 consecutive weeks of net shorts last year. This is the longest run since 2007. And since the CFTC amended its disclosure format in 2007, there's only 3 times in history where gold has been net short in a net short position, twice in 2015 and once last year. I touched on the official sector and so the central bank activity, and last year was very impressive. So net purchasing has been the norm now for some 9 years in consecutive years. But the level of buying we saw last year was particularly significant, jumping by almost 50% to over 540 tonnes. This is an impressive increase of trend towards holding gold by the central banks can really be attributed to three main factors. So one is a slight increase from CIS countries, and secondly from fresh purchasing from emerging markets, which we haven't seen in prior years, and this is some markets for the first time this century. And also thirdly, we've seen a decline in gross purchases. And CIS countries, as I mentioned, sort of are no strangers to purchasing gold. The level of purchasing for both Russia and Kazakhstan, 274 tonnes and 51 tonnes last year, marked the highest level of purchasing from these countries this century, with Russia recording its 13th consecutive year as a net purchaser and the 7th consecutive year as the world's largest global acquirer of gold. So in last year we saw the CIS as a region take over 62% of net purchases. So mine production last year grew some 2%, with the strongest gains in Indonesia, the United States and Canada, with offset losses in Peru, China and South Africa. Australia is the second largest producer, also posted a strong year, up some 6%, following a record high at Cadia Hill and a solid performance at Tropicana and at Kirkland Lake. On the other hand, China's production fell by 6% last year, representing the fourth consecutive decline for the world's largest producer, following tighter environmental policies. South Africa, once the darling of the industry and used to top the chart, experienced several labour disruptions last year, which in addition to lower grades saw production fall by some 12%. And Peru also was down by 4% last year. So total cash costs rose by 5% last year, and these are in US dollar terms, to a price of $6.96 an ounce, while all-in sustaining costs increased by 4% to almost just shy of $900. So higher fuel costs and lower grades were the main reasons behind the cost rise, partially offset by significant currency depreciations in Australia and Argentina and Indonesia. Africa, the world's highest cost region, posted a 3% gain last year in terms of costs. Costs in South Africa particularly, we saw with multiple disruptions and power cuts and mining difficulties push costs to near sub-economic levels last year. On the other hand, Russia represents the most cost competitive country out of anywhere. Okay, so now we've got a reasonable benchmark on what happened last year. So I really want to just touch on what we've seen this year, and it's been quite a contrast in terms of demand particularly. So you might note the most notable difference this year is the relative decline in physical demand across the board. But the strong inflows of metals into global ETFs have helped to keep the net balance in check. So you can see the impact of the elevated prices in the third quarter had on physical demand, down some 26% for the period. Jewellery fabrication, which makes up around half of total demand globally, was down by 55% in the third quarter, quite an outstanding result. Particularly driven by a very sharp decline in India, which was down by 55% for the quarter, as the Indian rupee was considerably weak and pushed gold to unaffordable levels for many. China and Europe was also saw a double-digit decline in the third quarter, based on the higher gold price, but also on a weak economic footing as well. Retail investment, which includes bars and coins, also fell by some 25% last year, as profit-taking and another massive fall in India accounted for the bulk of the decline. The Indian demand fell by a staggering 75% in the third quarter alone. While bars and coin demand may have fallen, investor demand from the professionals entered the market through ETF buying, and we saw almost 250 tonnes of net buying for the quarter. So year to date, we still have physical demand down by some 6% this year, with the weakness in the third quarter offsetting some modest gains in the first half of the year. So jewellery fabrication is still down 11% on 2018 levels, while retail investment remains 10% lower than where we were last year for the same period. ETF inflows have jumped by over 350 tonnes, and it's just shy of that record level holdings. So with demand considerably weaker this year and supply rising 5% on an expected record high mine production this year and also rising scrap levels, we have a significant rise in the physical surplus. With strong ETF demand, the net balance of around 270 tonnes is some 17% lower than where we were last year. So physical bar demand, which makes up the largest chunk of investment demand, fell 10% for the first 3 quarters, while demand from the US, Europe and China were fairly steady. Demand in India fell by 18%, as the increase in the gold price really turned down demand. And after bottoming in 2015, this year will be poised to become the 4th consecutive year of recording annual increases in terms of tonnage being held in ETPs or ETFs. As at the end of Q3, total tonnage is just shy of that historical high back in 2012 when tonnage was around 2,700 tonnes. So I've already mentioned the impact of higher prices on the jewellery market, so I won't go into detail. But it is worth highlighting the impact was mainly experienced in the price-sensitive developing world, rather than, and primarily in India, rather than in industrialised markets. So global demand was down 11%, but advanced economies was only down by 4% for the period. North America was actually broadly steady for the first 3 quarters this year compared to last year, while the developing world was weaker by, as I said, 12%. The Indian subcontinent was the hardest hit and was 20% weaker than in 2018 for the same period. And just highlighting India again, is just that the first half of the year wasn't as bad as the third quarter. So for the first 3 quarters, jewellery consumption is still some 9% weaker than last year, but retail investment is also 15% weaker than it was for the first 3 quarters last year. So just touching on, finally, on supply, global mine production this year looks to be on target for a record level. We saw around 1,650 tonnes in the first half of the year and around 865 tonnes of production in the third quarter. United States and Russia producing we saw some good gains from those 2 markets, whereas Australia and South Africa saw slight declines in production for the first 3 quarters. We are expecting, as I said, a 2% rise this year to around 3,385 tonnes. And in the current scenario, with the price being where it is, we are seeing a significant amount of exploration and interest from the mining companies. So we are expecting this sort of growth in the mine production to continue now for a few more years. And just touching on the mine costs for this year, we've seen another 2% decline in the second quarter this year to around $654 an ounce in US dollar terms, with all-in costs around $833 an ounce. And higher production and weaker local currencies in some local producing countries were the main reason for this slight decline. So there's certainly a lot of margin for those producers. And finally, just to our outlook for this year, we've seen a modest rise in physical demand in the last couple of weeks since the gold price fell back below $1,500 an ounce. Indian demand has firmed slightly in this last week or so, following a very weak Diwali, which is a very important part of the Indian calendar. And we have seen some bargain hunters also coming back into the market in the last week or two with some good flows going back into China. Jewellery demand we expect to be around 12% lower this year, which is the lowest level this century. We haven't been to this level since well back into the 90s. Just to give a bit of comparison, back in 2000 we had jewellery demand of around 3,200 tonnes. That compares to a figure of 1,874 tonnes this year. We expect the sort of current macroeconomic climate will continue to drive investment demand, both on the physical markets and via the futures and ETF markets. So the full year, the market will be a considerable surplus this year, with a net balance of around 500 tonnes. And for gold, unlike sort of other metals like platinum or palladium, for example, where the fundamentals play a much more important role, these sort of findings do not really have a really big bearing on what's going to happen with the gold price in the short to medium term. But it is worth keeping in mind or understanding what the market, what the fundamentals are saying to us, so we can understand what's happening this year and what might happen in the next 5 and 10 years. But it's certainly worth keeping in mind what's driving the gold market as we look forward. I think I'll leave it there, and thank you very much. Thank you.